Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry, and I'm delighted to be joined for the first time on Money Sense by Camilla Anderson. Camilla is a fund manager at Overseas Asset Management, an investment management company right here on Ireland. Camilla is joining us today, having recently returned from a research trip throughout Europe, something we will definitely be talking about. But first of all, let me say good morning and welcome to you, Camilla, to the cauldron and the inquisition that is Money Sense Cayman.
Good morning, Simon. Thanks so much for having me on the show.
Well, you may not be saying the same towards the end, but no, I'm kidding. First of all, let's just understand Overseas Asset Management. I'm familiar with them. I'm in the investment industry, so I should be familiar, but a lot of our listeners perhaps wouldn't be. So who or what is Overseas Asset Management?
So we're a boutique investment manager based here in Cayman, and we focus on non-US equities. So we run two funds, a OAM European Value Fund, which, as the name would suggest, focuses on investing in Europe and the UK, and then OAM Asian Recovery Fund, which focuses on Asia, ex-Japan.
Oh,
yes.
I got that one.
That.
Okay. Well, that leads into, I guess, the first topic that we wanted to talk about, which is value investing. So one of the names of your fund, the European Value Fund. And there's a lot of words in the investment industry which are potentially confusing to people who aren't in the investment industry. Value sort of seems somewhat obvious, but maybe it's not so obvious. So perhaps you could help us understand what value investing is, what it differs from others.
So, these labels kind of help to steer people in different directions, but really there's a lot of nuance involved in how funds are labelled and how different strategies are labelled. So the two kind of main strategies are growth or value, but there's variations in between, and often a lot of strategies mix different elements of both. But traditionally, value investing is about buying securities that appear undervalued on the basis of fundamental analysis. So we're looking at companies that we think are trading for kind of 60 cents on the dollar. So they're trading below what we consider their intrinsic value to be.
And how are you, well, that leads to an obvious question, I suppose. What metrics are you using to determine intrinsic value in that basis?
There's so many different ways. So this is where it really gets interesting, is that as we're stock pickers, so we invest in individual companies, and so we assess each company individually on the basis of the type of company it is, the type of assets it has, its business. So there'll be certain companies that we would value on a price to earnings basis, others that we would value on book value, for example, or sometimes there are holding companies or conglomerates that have lots of different businesses within them, and so we would value each individual business and then add them up as a kind of sum of the parts basis.
Now, this sounds eerily familiar to a well-known investor's approach then to investing. Warren Buffett, is that akin to how he invests in terms of looking at companies on a fundamental valuation basis then?
Yes, it is, definitely. He's the most famous value investor. There's been so many funds launched on, following his style. I think that the pilgrimage to Omaha every year really stands testament to Warren Buffett's.
Have you done the pilgrimage yourself?
I have, actually. Yes, I think I went in 2018, and it was a true experience.
Well, that's a set of adjectives. I don't know where to take that. A true experience. Okay. Well, value investing though. Are there different styles of value investing then? Give me some more.
I think everyone takes a different approach, and even within our own fund, we take a different approach when we look at different styles of company. So, for example, one area that we invest in is companies that we consider to be market leaders in Europe. Traditionally, we do invest in large caps, but we kind of see that there's more opportunity in small and mid caps. So there'll often be companies that are market leaders within a niche sector. So those are companies that are running very efficiently, they've got high return on equity, they've got high operating and profit margins, and they're also growing revenues and earnings per share.
Well, so that was where I wanted to go to, because you said the word growing, which is part of the same word as growth, which is the opposite, in a sense, style of value investing. So there'll be people listening to this screaming, going, but none of your companies are growing, or there isn't any growth. So how do you reconcile those two things?
Well, often growth is a part of value investing as well. So we are also investing in companies that we consider to be growing, but we're not investing in companies that are trading at very high multiples that are priced for perfection. So that growth has to continue compounding at 20% or something like that. We're investing in companies that are trading at a low valuation multiple but are still growing.
Would it be fair to say then that a typical value investment portfolio, in a sense, should be less volatile than a growth portfolio, should less exposed to wild swings because it's not priced to perfection? Or how would you explain the risks that people are taking in the growth?
Often, that sort of characterized as a margin of safety, for example. So that's probably one of the main aspects of value investing, is this idea of a margin of safety. So it's not priced to perfection in the same way as growth stocks might be. But again, when you're investing in individual equities, there's always room for volatility, and that's part of the risk-reward trade-off. So I would hate to say that they're less volatile. And certainly some I mentioned the market leaders that we invest in, but we also invest in what we consider to be deep value companies as well. So those will be ones that are trading at a discount to book value or trading at extremely low price to earnings multiples. And this can be for a particular reason, because that sector or industry might be completely out of favor, unloved, or they can be highly cyclical. So those companies can be quite volatile.
And that's typically one of the major, I suppose, stresses that a portfolio manager or a fund manager in a value sphere would have, which is this company looks very cheap, but how do you disentangle it's cheap for a good reason or a solvable reason versus it's very cheap and it's about to go bankrupt next year, sort of thing?
That's why we do the fundamental analysis. Right. So reading all the annual reports, going back through all the earnings calls and quarterly statements, really understanding the business. And again, that goes back to my recent trip to Europe, where I went and met with the companies that we invest in. I met with the CEOs and CFOs, attended capital markets days, and actually went and saw the assets on the ground in real life to make sure they're really there.
That's an interesting one. Would it be typical to say that in a value portfolio, you're going to have companies that typically have more physical assets than perhaps like an Nvidia, a Facebook type Google, where you can go to someone's office and kick a few humans? Well, obviously don't do that, but you can't necessarily kick machinery or kick physical equipment in the same way. Yeah,
and again, that's why we invest in a lot of different types of companies and really assess them on the basis of each company's activities.
And I'm always intrigued, management in value companies. I mean, are these people wishing that their companies were growing faster, or are they? What is there a different sort of behaviour to people who are leaders within the companies you invest compared to the leaders who you might see in the likes of a Google or Nvidia?
So there are. I mean, again, it does go back to each company being quite individual, but one kind of thread throughout our investment strategy is investing alongside the controlling shareholder or the family that have a significant stake in the company. And we consider ourselves to be long-term value investors, so we take a very long-term perspective. So we do like to invest alongside people who are looking at their company's operations in terms of the very long term, so generations rather than quarter to quarter. So quite often we do find that these people have a bit of a different approach to capital markets, and they might... Also, they might not consider their company to be a value investment. We see it that way rather than them.
Is that you said about the length of time that you typically look to invest. Is that a necessity for a value investor, in the sense that you're not necessarily going to get rich tomorrow because of because of market behavior and something's not likely to double or triple? So is the long-term horizon more necessary in value than it might be in other styles?
Yes, I think it is. It also goes back to we consider ourselves to be kind of contrarians, and so we look at things in a different way to the traditional investor. So we're looking to buy, particularly in the deep value strategy, companies that might be out of favour or unloved or just not trendy at the moment. So yeah, you do need to have a longer time horizon for that investment thesis to work out. And again, when we're not looking for necessarily significant growth on an annual basis, it can be a bit more of a lumpy investment We've held some of the companies that we've invested in for 20 years.
Oh gosh, are there any sectors that you've never invested on? You wouldn't, or maybe not wouldn't, because things can change. But
so there are certain ones which we would traditionally shy away from. We consider ourselves to be generalists rather than specialists. Tech is one that generally does not fall into value investing at this point, although you can find companies that might. Biotechnology is one which I think you really need to be have very specialised expertise in to invest. So, for example, we do have exposure to biotech, but we've invested in an UK-listed investment trust that specialises in biotechnology. And again, we bought that at a discount to net asset value, which gives us that margin of safety as well.
What about sectors that are more common then in a portfolio of a value investor? So if someone's listening to this and go, I like this idea of looking at companies that are relatively cheap to fundamental value, but where should they start hunting for those sorts of companies? Where are the best places, not necessarily geographies, but the sectors that are more, these sort of companies are more commonly found in?
It's generally the things which are not kind of flavour of the month at the moment, so probably outside technology. That's probably where most of them are. We do look at cyclical companies. We've had quite good experience investing in shipping, for example, which a lot of people hate investing in, but we quite like cyclical companies when you can buy them at the bottom of the cycle and then sell at the top of the cycle. Consumer goods as well, retail. A lot of people shy away from retail because it can be a very, very difficult business to run. It's very much exposed to consumer sentiment. But again, when we think that we can find the right kind of companies to invest in, those can be really powerful investments. And
you said that when you're doing value investing, there's a whole range of different metrics that you use. Is one, I guess, I'm trying to sort of put myself in the shoes of someone who's listening to this. Is there one that people should become more familiar with in order to just start that process, to start that analysis? Appreciating that there are many, but where should someone start their path in this regard if they wanted to? If they want to invest themselves, starting with a fundamental analysis, I would probably advise that they read a book about it to get a good understanding. Hang on, do people read books nowadays? Or a podcast or an audio book. But there are certain... So really what we do is we're trying to balance quality with value. We're not investing in companies that we think are bad and going to go bankrupt. We generally invest in companies that have got strong balance sheets, even better if they've got net cash on the balance sheet. So always start looking at the balance sheet, make sure that they're in a solvent position, make sure they've got enough cash to cover their liabilities. And then we look at quality metrics as well. So high return on equity. Again, it depends on the type of business. Your asset-heavy businesses will generally have a bit of a lower return on equity, whereas your more asset-light businesses have much higher returns on equity. And then we probably default to price-to-earnings multiple when we're looking at operating companies. You mentioned something a few moments ago. You said about families who are invested in this, and you often invest alongside families. This might segue in a moment to talking a little bit more about Europe, but it's not... Well, if you put yourself in the shoes of a North American investor, and the typical approach we go, oh, there's a family investor that you tend to shy away. That sort of implies they've got control, they can do things which are outside of the traditional capitalist preferences. They might favour their family as opposed to other shareholders. So how do you overcome, how do you begin to overcome that particular hurdle? That's definitely a big hurdle, and that's one where we spend a lot of time making sure that that we really do have a true alignment of interests with the controlling shareholder. So as minority shareholders, we are somewhat limited anyway. So we look for a controlling or a family that controls a company that has a very strong long-term track record of treating minority shareholders favourably, of growing the company in the way you would expect, and also we look at how they behave. We read newspaper articles about the family. We also look into how they pay themselves. It always comes back to money, doesn't it? So if you look at the remuneration, you can really see where the alignment of interests lies. And for example, I met with the fifth generation CEO of a company that we've held for a long time in Norway.
2 weeks ago and sat around a table and had lunch with him, and you get to have a pretty good idea of a person when you've met them a few times and you sit down for lunch and they are pretty candid with you.
Is there, as you were saying that, I was wondering, is there actually much of a difference between a family owning a significant part of a business and what is more common perhaps in sectors you don't invest in, the tech sector, where you might have dual class of stocks, where yes, you have the economic rewards potentially, but you have no ability to make some substantive changes to management or to strategy because the founders may own a particular class of share. Is there really a difference between those two?
Oh, and it's a great example. And again, I think it really comes down to assessing if there is that true alignment of interest. And we have had experiences in the past where we've thought that the controlling shareholder understood minority shareholders and was going to treat them fairly, and hasn't. So that's really where it does come down to digging through the financial statements, seeing how they've treated minority shareholders in the past, and a lot of investing comes down to trust ultimately.
Well, yes, for sure. Now, I mentioned a moment ago that we might segue into Europe, and I think this is the perfect time, talking of families, which is often more common in Europe. You've just, as I said in the intro, you've returned from a 2-week tour of some of your companies that you invest in Europe. Well, I guess perhaps the first, or perhaps more obvious question is, why only Europe? I mean, not only Europe, but your fund only Europe, and you have a fund that's Asia. What happened to the Americas, whether north or south?
So we think that US equities are more difficult to take an active investment approach in. We think there's a lot more competition amongst investment managers there. And then also looking at the valuation of US equities at the moment, they're trading near all-time highs. So we think that Europe and Asia look very interesting in comparison to those. And clearly these strategies have been running for a long time. I think the European fund since 2002 and the Asian fund since 98, I think.
Cool.
So these are not new strategies. They've been developed over decades. But we often find that there are equivalent companies in Europe that are trading at much lower price multiples to the US. And again, I saw prime examples of these last week when I was in Europe. I went to a conference and I was swapping notes with other value investors, and they were doing presentations on US companies that were trading in a certain industry, trading at 20 times PE multiples. And I had an example of a company that, in my view, is a better company in terms of quality of earnings, market position, that was trading on just 9 times earnings.
And why would that be then? Money is freely transferable around the world most of the time. So why would such a company generally trade at such a low ratio compared to the equivalent in the US?
There's been a lot more focus on US equities recently, and I think even looking at foreign ownership of US equities is at an all-time high. I think foreign holders own about 20% of US equities, and if you look back to kind of 2007, 2008, it was more around 10%. I think it's about 18.5 trillion foreign shareholdings in US equities at the moment. US equities have generated stunning returns over the past decade, and there's been massive inflows into US equities as a result of that. But
at some point, investors are going to wake up, presumably, and sort of recognise the approach that you're saying, go, well...
Yeah, and we think they already are starting.
But it has taken... It's been like that for, how many, 20 years, 30 years, perhaps longer in some cases. In other words, the European market, from a returns perspective, has generally historically lagged behind the US market from absolute returns.
Again, if you look at it in cycles, right. You could look at it over different periods of time. I'm not sure that's necessarily the case, although, again, it really depends on how you analyse it. But we do think that there are a number of factors which are in our favour, which is, first of all, that US equities are trading at an all-time high, but in relation to that, European and UK equities are trading at relative lows, but that valuation gap is at the widest that it's been in the past 40 years.
I guess the only concern then is that gap could close from one or two ways. One is the stuff that you invest in goes up, which is great for your strategy. The other is the stuff you don't invest in goes down a lot, but nothing necessarily. You might do well relatively, but I guess you can't predict which one of those is going to happen.
I would never try to predict. That is definitely not what we try to do. But we also see that the US dollar is overvalued relative to the euro, pound sterling, and a few other European currencies as well. And we've already seen that start to shift this year, which for a number of reasons. I think it's the valuation extreme. Again, kind of like everyone's invested in US equities. I hear stories of portfolios that are kind of 95% US equities. It doesn't actually take that much for someone to just allocate 5% to another sector, and that change in direction can actually become quite meaningful. And again, with the currencies being at an extreme, it just takes a little shift in direction to actually become quite meaningful.
I was going to say you, but actually me. I mentioned Europe as though it were one homogenous place. It clearly isn't. It's made up of, actually, I should know how many countries, but there's quite a few. So when you look at investing in Europe, does the country you're investing in matter, or are you looking at trying to find good companies irrespective of the country they're in?
We're really focused on finding good companies, but we do overlay that with certain concerns over certain geographies. So we find that
are we going to pick on countries here?
No, I won't. Okay. I won't name and shame. But we do find that there can be not a strong corporate governance as we would like to see in certain countries, and again, that might surprise people. The types of countries that we find that those are actually slightly lacking. And then again, we've had certain countries where we have very good experience investing. We feel quite comfortable investing in them. I would say one, for example, would be Italy. Most people would not necessarily think of Italy as being a great place to invest, but we find that there are pockets in northern Italy of very strong companies that are run in a very efficient way, which you might not consider to be the case.
And are valuation levels, or are there more opportunities, leaving aside whether you like the opportunities perhaps, but do certain countries have more opportunities because of the historical situations with them, or the way, or are these opportunities that you find spread fairly evenly amongst various countries in Europe?
It does vary to a degree. There'll be certain countries where they I'd feel quite comfortable with high debt levels, and we don't like investing in companies with high levels of debt, so we would shy away from those. I think Spain might be an example there, where, again, I don't want to blanket in a whole...
Please do. This is perfectly fine.
Because we look at it on a company-to-company basis. But, yeah, there will be areas where maybe culturally they don't share our view of how to run a company.
And are there... Wait, so when you're looking in European countries, the political scene, you're having to assess, 15 different political situations. In the US, there's perhaps one. So how much does that play into the analysis? Because rules can change depending on who gets elected.
It does. It can very much. So we consider ourselves to be what's called kind of bottom-up investor. So we kind of choose the company to invest in, rather than saying, right, we want some exposure to Italy. Let's go and find companies in Italy. So it is very much dependent on the company, and again, the political situation can vary depending on the activities of that company. But again, a lot of these companies are European in name, but not necessarily in operations. So some of the Italian companies, for example, that derive 10% of their revenues from Italy. A lot of them are very global companies that might be deriving 75% of revenues outside of Europe. So that's definitely another angle to that.
Do you typically find then that some of the better companies that you have opportunities to invest in are internationally oriented, albeit domestically located? Everyone's domestically located. Is that typically then where you find the best opportunities?
Yeah, definitely. Okay. There's a lot of companies which might be a UK company, but the majority of their business is actually done in the US. And so you look at the equivalent US company and you can see quite quickly, you can make a quick comparison and see that the UK company is actually a pretty good investment opportunity based on the fundamentals.
I feel as though I'm going to have to raise the T word with you then in that case.
Dear, yes. Here we go.
Because you're just talking about companies based in Europe who are doing a lot of business in the US but are more, compared to their US equivalent, are lower, cheaper, less expensive to buy. But of course, tariffs are potentially an issue. So how does that factor into the analysis? Because that could blow up. Well, who knows? It could blow up anything, couldn't it?
It could entirely. And again, it really depends on the type of business, what their activities are, what they're selling, what they're buying, their currency exposure. So again, it's really on a case-by-case basis. But yeah, the tariffs will have an effect globally.
So you would then take that tariff analysis and plug that into your analysis of each company and go, well, we need to potentially adjust the profitability, the revenue of this company for these sorts of factors.
Yes, definitely.
And then try and assess whether they're still good value, still cheap to invest
and
in.
Clearly that's very difficult to do at the moment when there's not a huge amount of information about how the tariffs are changing regularly, how they might be implemented in practice. So it's. I
hope you're not criticising the stability of the current administration in North America. That would be a dangerous thing to do.
I feel like that's a leading question, Simon.
I feel as though everyone's questioning what's going on. So that's.
But I do think that it's that questioning which does feed into this investment strategy for Europe.
Does that scare people away from investing in the funds that you invest in at the moment, because they go, I listen to what you say and go, that sounds great, but now I'm scared about what the US government is doing to foreign countries and foreign companies.
That's a reason to invest.
Right.
I think that Trump's actions so far have shaken confidence in the US and made people realise that they might be overexposed to the US, and diversification is always a great idea in investment strategies.
Well, that could not be a better word perhaps to end on, with a message of sense to everyone listening, which is diversification. And I think, take your point, if everyone has invested in one particular asset type, US equities, that puts everyone in the same boat if things go a bit wrong.
It does, definitely. And I think that's one of the basics of investing, is to have a diversified portfolio.
Well, there we go. With those words, I need to say no more. Camilla, we are, as always on this show, out of time before we'd like to be. Thank you for joining us on Money Sense this morning for your first time.
Thank you
I
so
hope
much,
it's been a moderately pleasant experience for you, and that this will not discourage you from coming back and being subject to another grilling in future.
I look forward to it.
Yeah, perfect. Perfect. My pleasure. Well, look, just finally then, for all our listeners, just a quick thank you for tuning in. If you do have any topics you wish us to cover, email us at moneysense@cfacayman.ky. Otherwise, thanks again for tuning in, and please do rejoin us in 2 weeks' time.